Hello again, everyone. And we have had an outstanding program today, and we will certainly finish that way with two excellent programs, one of which will be on property inflation. You can't pick up a newspaper if anyone does such a thing anymore, or open a news site without hearing about inflation. The other dimension to our education today will be about social inflation and the nuclear verdicts that we're seeing in the jury room and in our courtrooms. Something that also, not just property inflation, but liability inflation, we most certainly will see flowing through our insurance premiums, and we're seeing that in combined ratios and rates, and will probably for many years into the future. So I'm going to have Victor open up our breakout rooms, and we have two excellent moderators as well, one of whom is Chris Faber, who is in fact a property adjuster, and Rodney Brennan from Liberty Mutual, who is a liability adjuster. So both of these professionals will be helping our breakout rooms navigate the talent and questioning that come from our speakers.
All right, thank you, Chris. Justin and I talked earlier. I was going to go first. We'll leave some times for questions as well. Let me share my screen here. All right, can everybody see that then? We good to go?
Yes, sir.
Good. As mentioned, my name is Greg Pine. I am the VP at Verisk over the pricing division, which is the group that publishes the construction pricing information used both on the claim side as well as the underwriting side. And let's jump right into it. So I have some different slides here I want to show you that give you information on trends that we've seen in the construction pricing and the claims world based on the pricing that Xactware publishes or within the Xactimate system. So first off, this slide, we have a certain basket of goods that includes labor and material for different construction items. A common set of construction items across the gamut from the ground up, including concrete, framing, siding, interior finishes, roofing, etc. We take that basket and we track it over time based on our published pricing. So as you look at this, the blue line is the national average of that dollar value of that basket of goods over the last year, while the darker line is California. So it makes sense that California, tracking that basket of goods, including labor and material, would be higher than the national average. You can see starting in September, the national average was around the $72,000 range, while in California, it was around the $81,000 range, and then that increased over the last year. California getting above into the 87, 88,000 range in that year time, showing an 8.1% increase in that basket of goods compared to the national, where we saw a 8.2% increase. And then overall, you can see that California, as of September, is tracking about 11.7% higher than national average. So it gives you an idea how California compares to the national average on this basket of goods for labor and material. This slide shows the same thing, but for Hawaii. So you can see that the dollar value for Hawaii is even higher. Again, the national average started at $72,000 range, while in Hawaii, it's at that $97,000 range in September a year ago. Hawaii increased up over $100,000 as of September, as of last month, while the U.S. increased just below $80,000. Again, the national average was an 8.2% increase. In Hawaii, we saw a 6.7% increase. So although Hawaii is about 30% higher than the national average in this basket of goods, the rate of increase is a little bit lower than the national average. Lumber has been a big topic on construction costs in the last year and a half. I've been doing construction pricing publication for over 25 years. We've never seen this level of volatility in lumber in the history I've been doing it. And this kind of shows you that. So this takes a common set of lumber material, both panels like plywood, OSB, et cetera, as well as other lumber, dimensional lumber treated, and tracks it over time going back to January 2018. You can see it was relatively flat for that 2018 into mid-year of 2020. And then COVID happened. And kind of what happened, just to look back at it historically, is that COVID happened, these mills that produced lumber, they had to make a decision. They had to figure out, how do we work with COVID? How do we get our employees in? How do we run these mills? They made an assumption that demand would go down. And so production came down. And then as it went on, the exact opposite happened. New construction continued to boom. There's a little bit of a lull. Then new construction continued to boom. People were at home. So do-it-yourself projects were a big thing. People were doing those. And then also there was the situation where remote work was now a big thing. And people were remodeling their house or making some changes in their house to better accommodate that remote work, whether it was finishing a room in the basement or adding an addition or redoing a room to have that office space. So we saw a large increase. Then of 2020, the latter part of 2020, people started saying, yeah, it's going to level out and go down and settle down. Won't be as crazy. Those are the predictions that were coming out in 2020. You can see if you look at it in 2021, that did not happen. It started to increase even at a faster pace and got up as high as 150% increase since 2018, with a high in July of 2021. Again, new construction continued to boom. During that time, interest rates were low. The demand was high for that lumber. Then we saw it come back down the end of 2021. Again, go back up in 2022 in April, but since then it's been going down. And now the predictions are that it's going to continue to go down and level out. And there's a lot more teeth to that prediction probably now with interest rates going up for mortgages. So people buying new homes, people, going to their equity in their home to do a remodel, that started to cool down a little bit. So we anticipate that lumber is continue to settle off through the rest of this year. Looking at an annual percent change, give a little different view here, maybe make more sense. In 2018, if you look at that increase at an annual review, it actually went down negative 1.14% lumber. 2019, it went down even more at 6.31%. Then 2020 hit, it ended at 53.97% up compared to the first of the year. 2021, it ended at 9.8% up, but there was a high at one point in July where it was 75% higher than it was at the point of at the beginning of the year. So far in 2022, it's up 6.93% through September, but there was a high of 41.75% in April. So this volatility in this lumber pricing really had an impact on the underwriting side. I have a slide here in a second that will show and illustrate that impact and decisions that had to be made on that side. In the claims world, lumber is not a big spend. It's in estimates coming through our system here at Verisk. It's 3 to 5% of spend on cost for lumber. So on the claims end of the situation, that's not a huge spend, but that increase did have an impact on the claims world. Labor was another big thing that was impacted. This tracks an average billable labor amount. We have Hawaii, California, and national. So this is a billable rate. Think of it like if you went to a mechanic shop to have your car worked on, and they say they charge $80 an hour for labor. That's not what the person doing the work is getting paid, but it's their billable rate to do that work that that company has to make money. So the average billable rate based on our published pricing for trades like plumbing, finished carpentry, like electrical, siding, any construction trade you can think of, the average increase in Hawaii last year was 7.5%. And you can see it started around $115, got up to be close to $120, that average hourly billable rate in Hawaii. In California, it increased 9%, starting around that $90 range, got up close to just under $100 range in 2022. Then the national average was, around 75, increased up to around $80, a 9.4% increase. So that billable rate increased drastically as well. To give you an idea, historically, on an annual basis, we generally see this being in the 2 to maybe 6% range in a high year, generally running between 2 and 4%. So double digit off of that increase. Similar to what we've kind of seen in inflation as well, in general inflation, but that impacted the labor side as well. The cost of having these employees was part of it. Blue collar worker, a lot of demand on that type of worker. They had to pay them more to get them to be on the job, which increased what they have to charge for those people doing that work. The cost of owning a business had impact as well. Along with that billable rate, if you break it down even further, in our billable rates that we publish, we break it down into the wage, so the amount the employee is actually getting paid, the labor burden, so the burdens that an employer has, like payroll taxes, worker comp, things like that involved with, then the overhead and markup they need to charge to create that billable rate. So those three pieces, wage, burden, overhead, markup, if you sum those three amounts, they would make that total billable rate. Here it shows the percent change for each of those portions of the total billable rate. Blue is Hawaii, the yellow is California, the green is national. So you can see as far as wage, Hawaii didn't see as big of an increase in the wage, and this does not show the actual dollar value of the wage. Hawaii's wage is actually a lot higher than California and the national. California saw a 5.5% increase in these wages, national at 5.7%. The burden amounts increased 12.3% nationally, 11.7% in California, 8.5% in Hawaii. That overhead markup portion is 10.6% nationally, 10.2% in California, and then just over 9% in Hawaii. So you can see that an increase of that billable rate was realized across multiple areas of that makeup of that billable rate. Obviously, as you know, the amount you have to pay employees to do work is going to impact what you have to bill at a rate to be able to make money and stay in business. The cost you have for burden and the overhead and markup involved in that is all impacted directly to that billable rate that you use. This is the slide that I want to talk about for the underwriting side. It's a little bit confusing, so let me explain it. On the underwriting side, lumber has a bigger impact because as you're evaluating the cost to rebuild a home from the ground up, in general, lumber is going to be 15 to 25% of the total spend to build that home from the ground up in most cases. You know, there's areas where maybe lumber's not used as much, you know, maybe some areas in Florida where concrete's used more or block, other areas in the South. But in general, lumber is a lot bigger expense when you figure out the underwriting side of things. What would it cost to build this home from the ground up if it were completely destroyed? So the yellow line tracks lumber costs, and the right side is the percent change. So you can see it got up as high as 150% since January 2019 with that yellow line for lumber. The other bars are a reconstruction cost index that we publish. This reconstruction cost index takes 30 sample homes of different quality, sizes, and grades and builds them from the ground up and what it costs to rebuild those, then tracks that cost over time. So you can see mid 2020, this looks at comparing what that reconstruction cost index was to 1 year ago. It was relatively similar. It's between that 3 to 5% range, whether you look at it in September, May, April. So if you compare April 19 to 2019 to April 2018, you see around a 5% increase. And it varies based on Hawaii and California. You can look at that. The general trends are the same. You can see when lumber started to be very volatile, these reconstruction cost indexes really varied based on the month you compared it and how lumber was moving. So look at like July of 2021, you can see those reconstruction cost indexes in Hawaii got as high as 20% comparing it to a year ago. But if you go to look at December of 2021, that index is a lot lower. It's in that 8 to 9 to 10% range. Now look at July of 2022 was even lower at below 5% comparing it to a year previous. So these indexes became a lot more volatile because lumber was volatile, because lumber is a big spend in the cost to rebuild a home from the ground up. So the underwriting side of the house had to look at that. It was more challenging just to take an index at a certain point compared to a year ago, where before was relatively similar no matter what month you picked in the year. Now that changed drastically as lumber went up and down. Average return claim value. So estimates coming through our system from our different insurance companies that are customers of ours. This shows it for the California average, national average, and the Hawaii average. National is blue, California is yellow, and Hawaii is green. You can see that California has the highest average return claim value. It started as high as 19,000 a year ago, and then it's gone down. It came up a little bit. National has been a little more static, you know, hovering around that $13,000, $12,000, $14,000 range. Hawaii is a little bit less, although the costs in Hawaii are greater. The average claim value is less, which is an interesting thing to look at. Although, like I mentioned, the cost to do repairs are higher in Hawaii. The average claim value is less, and that is due to the type of claim. California has a lot more total losses in the last while because of things like fire and things like that, where Hawaii has not had that as much recently. But something that's interesting to look at as far as claim volume or claim value for the national compared to California and Hawaii. This is another interesting slide where we take the top 200 items by spend and look at them over time, again, at California, Hawaii, and national. So the top 200 items in claims by spend, which tend to be things like roofing, water things, drywall, paint, common things that are in claims, and track just those items over time. You can see the national average is up 12% in that year period. California is quite a bit lower than that, just below 8%, and Hawaii is around 10%. So interesting to look at those common items by spend in claims, what's the high spend claim items, and how they track over time. Again, the same kind of thing. The trends of this previous to the last year and a half were more in that normal 1% to 4% range. We're seeing double, triple that now with what's been going on with the way the economy has been and inflation in general. This takes the top 200 items by use, so just pure count. So for example, a top spend item may include wood shakes, although they're not maybe used a lot, they're very expensive. When a claim comes through wood shakes, it may be a top spend item. A top use may be something like, extraction of carpet, water from carpet, where it's used a lot, but the dollar value is less. So maybe it's in the top spend on the lower side, but it's in the use on the higher side. So looking at those top 200 by use, again, the national is green, California is yellow, and Hawaii is blue. A little bit lower than the spend one. National is around 10%. You can look at California and Hawaii there. The main difference in where these start to separate, if you actually put them together, they would run very similar until the early part of 2022, where we saw some roofing costs go up quite drastically. And roofing items that were in the top dollar spend portion of it were not in the use spend. And so we started to see a separation where the dollar spend increased a little faster. And that was due to these roofing items that were in the top spend, like wood shakes, but were not in the use. Another thing that's interesting to look at the spend by category coming through our system for the current year, January to September. You can see nationally, roofing is by far the biggest spend coming through our system at 32%. Which is not unusual. I mean, that's, if you're in the industry, that's something you're aware of as far as nationally. 32% of the spend coming through our system is roofing items. The next is paint, and that's clear down at 4.9%. So a big decrease as far as the percentage. Then wood flooring at 3.8%. Framing came in there at 3.3%, probably a little higher than normal because the cost of framing went up so much. Siding 3.3%, water remediation, which is a huge amount of claims that come through the system. But as far as dollar value spend, they're only at 3.1% nationally. And you can see from there as it goes down the type of things that are the top spend categories nationally. Now, if you take this and look at California, it's very different. You see the top spend are cabinets and painting at only 6.6%. So California does not see a lot of roofing claims. Don't have a lot of hailstorms or wind damage of that type. So the roofing claim is not anywhere near what it is nationally as far as spend, which is very interesting as you look at that. Wood flooring, 6.1%. You can see water remediation is 4.4%. Framing is 4.3%, and roofing is only at 4.1% compared to the 32% nationally. That's just the makeup of those claims and how they come through. Hawaii, very different breakdown as well. Although roofing still is the top dollar spend, it's only 18.8%, which is a lot lower than the 32% nationally. Again, this is based on estimates coming through our system as our customers write it. Painting's number 2 in Hawaii at 7.5%, wood flooring at 6.8%, and drywall at 5.7%. You do notice that in all these, wood flooring is one of them. Generally, when there's a water loss, carpet they can save. They can usually dry it out. Wood flooring is harder to save. And then also the other situation is that a lot of homes are moving towards these hard surface flooring. If you look at the new construction market, remodeling, as people put in new flooring in their homes, they're generally going to a hard surface, not putting carpet back in. So that's an impact as well, where more homes are seeing these hard surfaces of flooring versus having carpet. That is the last of the slide deck we went through. I'm open to have questions. We'll probably let Justin go through and show his information. Then once he's done, we'll have questions that he and I can answer together. Well, Justin, I'll turn it over to you.
Great. Thanks, Greg. Let me share my screen. Everyone see my screen okay? Hear me okay?
Yeah, I hear you.
Good, good. Awesome. Thank you. Appreciate the introduction. My name's Justin Woodworth. I'm our sales manager here at Inservio. Anyone not familiar with Inservio, we are a Solera-owned company in the contents inventory and valuation space. Been in business since 2004. So with that, we've got over 18 years worth of contents data that gives us a pretty unique perspective into what's going on with the industry as it relates to inflation. And happy to be here and walk you through some of the numbers and some of the trends that we've been seeing over the last few years. Agenda real quick, some of the numbers and breakdowns that I have in here, give you a quick overview as far as inflation's impact on P&C loss costs. I've got a category breakdown in here, so we'll walk through different categories of items, what those trends look like, what kind of impact that's having on consumer behavior, and then a couple of different ways that carriers can look to try to counter inflation as well as we close it out. So overall, just looking at inflation's impact on property and casualty losses, roughly up 30 billion over the last year, with 3/4 of that coming from personal lines alone. As we look specifically at homeowners and commercial multi-peril, that's making up more than 1/3 of that 30 billion in increased loss costs. Quick visual here just to show you a little bit of a breakdown from the Consumer Price Index. September 2022 inflation from the last 12-month percent change is at 8.2% across all items. And then looking at some of the high-level categories, food 11.2, energy, as we all know, is through the roof at 19.8, and then all other categories sitting at about 6.6 right now. Breaking it down further by category. So what this visual shows, I know there's a lot going on here. This is looking at Inservio data, specifically our top 10 categories by indemnity spend over the last couple of years, going back to 2020. Top categories: collectibles, lawn and garden, musical instruments, apparel, bed and mattress furniture, all other furniture, sporting goods, appliances, electronics, and artwork. Again, those are our top 10 based on indemnity spend. So as we look at the total RCV of items across all of our customers, those are the top 10 categories with almost every customer, regardless of where they write, whether they're a traditional homeowners carrier, high net worth carrier. These are almost always going to be the top 10 categories. What we're looking at is what the average replacement cost value per item is through each of these categories and how that compares to what the trailing 2-year average looks like. I have this sorted based on the year-over-year variance. So collectibles is obviously by far and away the largest variance in relation to some of these other categories. Most likely in large part due to the pandemic. A lot of those types of items just took off when you look at things like trading cards, sports memorabilia. Those sort of things went through a real boom over the last couple of years, as you can see, up almost 54%, 2022 versus the 2020, 2021 average. Lawn and garden, musical instruments, apparel, these are all big drivers. I will also point out, these are really our high-level parent categories, if you will. We do have other subdivisions under these categories as well. This is in large part followed by the Joint Military Industry Depreciation Guide is where these categories come from. So I say that when you look at categories like electronics or appliances, obviously that's pretty high level, right? You can have a breakdown of TVs versus computers versus audio equipment, things of that nature. But high level, this gives you a pretty good idea of the trend and what's going on in the industry. As you look at the last row, the average across these top 10 categories is up 12%, 2022 year to date versus the average of the 2 years prior. Next, we have a breakdown, same thing off to the left is what I just showed you on the last slide. Those are our averages across the US as a whole. Off to the side, I have the total specifically looking at California and Hawaii as a collective. Overall, pretty in line actually with what Greg just shared over the last few minutes. Pretty significantly higher in those two states versus the national average. California and Hawaii is up almost 21% 2022 year to date versus the trailing 2-year average. In relation to the US as a whole, pretty much half of that. Next few slides, just honing in on some of those top 5 or 6 categories. What we're looking at here is data from the Consumer Price Index, Bureau of Labor Statistics. So we're going back even further than when Inservio was born, if you will. This slide here, specific to apparel, goes all the way back to 1913. Between 1913 and 2022, the average inflation rate for apparel was just under 2%. 2022, we're sitting at just over 5%. I thought this was interesting too, the statistic in the bottom right-hand corner. Apparel priced at $20 back in 1913 would be the equivalent of $170 today in 2022. As you can see, a lot of that volatility goes back years and years. Over the last 5 to 10 years, things have settled down a little bit, but again, long and short overall, 2022 apparel's up 5%. Next, looking at appliances, going back to 1997, average inflation rate was negative 0.46%. 2022, we're at 5.4%. And again, appliances priced at $20 back in 97 would be the equivalent of $17.81 today. Furniture and bedding, last couple of years, obviously took a pretty big jump here, as you can see, going back to the start of the pandemic. National average going back to 1935, just 2.5%. 2022, we're all the way up at 12.13%. Jewelry, similar trend here. Average going back to 1986, just 1.74%. 2022, we're at 2.86%. Not too big of a jump there. Jewelry at $100 back in 1986 would be the equivalent of $186 in 2022 today. Televisions, I'm sure a lot of people on the call today have purchased a TV in the last few years. This one's pretty interesting, as you can see. In particular, just going back to 1980, you can see the trend there, right? Going all the way back to 1950, the average inflation rate year over year was negative 6%. 2022, it's all the way down to negative 9%. We did have one little blip there back in 2020. Again, I'm sure that was in large part driven by the pandemic. Cost of TVs actually went up for a short period there before plummeting back down to that negative 9%. But TVs, $1,000 in 1950, if there was such a thing, would be the equivalent of about $8 today. Tools, hardware, and supplies, similar story here. Average inflation rate, 0.5% year over year, going back to 1997. 2022, that jumped all the way up to 9%. Again, that's pretty in line with what Greg just shared with us over the last few minutes. Tools and hardware at $20 back in 97 would be the equivalent of $22 today. So not too much change there other than the last couple of years. So based on what I just shared, what kind of impact is inflation having on consumer behavior? Pretty cool what's going on here. Consumers are buying less. I'm sure that's no surprise to anybody, myself included. Consumers are embracing installment type payments, in particular for high dollar items. I'm sure most everybody has probably purchased something online fairly recently. It seems like almost every time you go to buy something now, whether it's $1,000 or $100, you have that option to pay in installments. Installment type payments actually grew by 66% year over year, although online orders in the US actually declined 7% year over year. We've also seen buying interests are changing. Consumers are turning to hard assets like real estate, commodity stocks, bonds to really stave off the negative impacts of their personal wealth. And what's interesting enough is shoppers are also investing in luxury goods. Reason being, maybe some of those who can afford such luxury goods like apparel or handbags, which grew 23 and 30% respectively, maybe not as impacted by inflation as some others might be. And then those are also items that probably aren't going to depreciate as much as other items. Some, in fact, may actually appreciate. So certainly seeing a change in consumer habits there as well. And then finally, how do we counter inflation? First and foremost, leverage data. There's a lot of data that both Greg and I just shared with you guys today. Leverage both your own internal data, rely on your vendors and the data that they're able to share. As we all know, numbers don't lie, right? So try to leverage data as much as we possibly can. Focus on creating maximum insight into product profitability. Maintain superior underwriting, pricing discipline, including expense pricing discipline as well. There's a big focus across the industry on increasing claims productivity and automation when and where applicable. We want to invest in automation. Straight through processing is a buzzword I'm sure we've all heard over the last few years. Huge push across the industry to leverage straight through processing and automation, really in every way, shape, or form, whether that be first notice of loss, whether that be claim settlements, whatever the case may be. And then, of course, try to accelerate and innovate loss prevention capabilities. In summary, insurers that are investing in operational and financial resilience today will almost certainly grow stronger and be better able to withstand future shocks like we've been going through over the last couple of years. And with that, happy to open it up to any questions that may be out there.
Fantastic. Thank you, gentlemen. Does anybody have any questions? You want to drop something in the chat, or you just want to unmute yourself?
I did learn from Justin that I shouldn't invest in TVs for a future retirement. So.
The longer you wait, the cheaper it'll be.
Hey guys, I did have a question. Can you guys hear me okay?
Yeah.
Okay, cool. So we see with, high inflation numbers, that's definitely been the case the last couple of years. We understand the circumstances. We understand why. What I found is it seems a lot easier to raise the prices than for companies to bring them down after they've already done such. And so I wonder, what are we really looking at here as far as goods that now the demand has lowered, but the price is still staying the same? Or is it going to continue to level off, based on maybe a historical reference?
Yeah, I'll answer that first, Justin, on the property side, or give a try at the answer. So you are correct that upward pressure happens a lot faster than downward pressure. And I'll give you some historical reference. So if you remember back in, I believe it was 2008 with the real estate crash, and homes were being sold for pennies on the dollar in some areas and things like that. there'd been an increase going on for quite a while. Construction was busy, and this happened, and construction kind of died, or did die for a while. It was not anywhere near as much. And for downward movement, it takes a lot more pressure and a longer period of time for that to happen. So during that time, as far as construction costs themselves, you will not see them decrease at the same level as cost of homes, because they will sell those cost of homes for a price less than what you'd have to pay to build that home from the ground up. So you do see decreases, but they can't go below what their costs are to do it. And it takes a lot more pressure. So for example, back in that time frame, flooring is a common item used in insurance claims, but it's also common in remodeling, and new constructions use it as well. But if somebody's going to upgrade their home, one of the first things they do is flooring. They change the flooring out. So we did see flooring decrease faster than maybe some other things. So there was more pressures from different areas involved in that. We did see a lot of contractors have to weather the storm and go through that, but it does take a lot more pressure for downward movement. And what we tend to see in the property side, let's say a catastrophe goes through and prices increase. As the catastrophe gets finished out, we don't generally see prices decrease and come back where they were. They kind of level out and kind of stay there, for lack of a better term, unless there's other outward pressures in the economy to move them down. But on the construction side, there's a certain point where I can't increase volume or do more work. I can't if I don't make money off of it. So whether I do more work, but I'm not going to make money, that doesn't help. There's a certain level where the cost of the material and everything and the labor stays at a certain point. So it's not going to decrease the same amount that maybe, home sales would be, because it's not the same animal, if that makes sense.
Yeah, home sales tend to get nervous quicker.
Yes, and they tend to even go below the value where they're sold at a loss.
I see. Yeah, I noticed that when we're talking about prices for contractors, we're looking at a lot of different industries that they connect with, a lot of different suppliers, and so it moves slower.
Yeah, and even this year, so the home prices have increased, interest rates are up, so construction is starting to slow down. But there was a big backlog of projects already there, and the claims world is impacted by remodeling and new construction as well, because it's the same general blue collar worker pool they're going at. So there's still a lot of projects to be there. They're waiting for materials. So it started to level out. We haven't seen a lot of downward trend yet, except for things like lumber that really got quite high. If you think about fuel costs, the same kind of thing happens. You hear about impacts on fuel, and what does fuel cost do? It goes right up. It takes a lot more pressure. Then the price of a barrel of oil goes down. The downward movement's a lot slower to happen in a longer tail or a longer period before it starts to happen when the actual crude oil itself goes down. And that's just because there's got to be a lot more pressure for downward movement than upward.
Thank you.
I don't know if there's anything you wanted to add, Justin.
No, I don't think there's really much to add on the content side. I think the only thing I'll add to that is, you kind of see the volatility and the cost of some of those categories of items that I shared with you over the years. One other kind of factor into all of that, and really issue that we've seen, is not so much the change in the replacement costs of those items, but just the general availability. You look at things like furniture. If anybody's purchased furniture in the last couple of years, you're not walking into a store and bringing it home the same day. You're waiting 6 months, 12 months. Even my mom waited almost a year and a half for a patio set that she bought a while ago. So it's things like that have become more of an issue than just the changing of the replacement cost values.
Yeah, I had a question just on how you're determining these pricing, and looking at your charts there. There's been some really significant movements just over the past couple of years. Can you expand upon how you keep up with this pricing and the challenges that go along with these fast increases?
Yeah,
Sure.
yeah.
Is that for both of us, Chris?
Sure.
I'll let you go first, Justin, this time.
Yeah, sure. So a lot of when you look at the data that I shared in the category breakdown, those are all based off of current like, kind, and quality replacement cost values. And the way we determine replacement cost values is through a database that we use that is essentially tied directly to almost all of the large national big box online retailers, your Targets, your Walmarts, your Macy's, your Best Buy, Apple, all of those, again, kind of the big box national retailers. We've got a database to collect all of their pricing on a nightly basis, and that's what we use to support our replacement cost values.
Yeah, and on the property side, as far as Verisk is concerned, we have been publishing monthly since like 2009. So that benefit alone that we're publishing more often helps people get more current information. We've added a lot more automated procedures, getting automated feeds for material pricing that has helped that process. We've also done a lot of analysis and review and able to share information across different areas because it has been a national trend. The labor piece of it, is a big part of the changes we're seeing. Being able to get information from the wage that helps impact that billable rate helps us do that. But it's been a lot of work, been very exhausting. We've increased team, increased different ways we're doing it, increased automation. But it's been a huge undertaking. One of the great things about the product Xactimate when you estimate claims is we show you that. So you can look at it. If you have a situation where you may not think it's correct for the area or the job you're doing, you can quickly look at what it is and validate that and make a change if necessary. But that monthly publication has really been a big help in getting that more out. Before monthly, we used to do it quarterly. And quite frankly, quarterly just would not be helpful in the last year and a half because of the quick changes that are happening.
And with catastrophes, fresh in mind with the hurricane that just hit Florida, how do you guys deal with that type of pricing? Because I know we hear about price gouging and we've got obviously limited resources in those areas. Do you guys do something special to address those situations?
Yeah, as far as Verisk goes with our published pricing, we step up our process, do more focused research in those areas, look at supply and demand and things that are going on. A hurricane's interesting. It's a little bit different than, usually if you think of a catastrophe, usually you think of a hurricane, just because of the country we live in. And in hurricanes, you can kind of work from the outside in. So where the eye goes through, there's lots of damage. You can't get in there for a while. As you get out in the peripherals, there's less damage, but there is damage. So you kind of work from that outside in portion. And they may not even be doing jobs in the eye where it went through for months in some cases, which enables you to look at those in a little bit different light and have a little bit more time to review them and go through them. We also step up our process, take some accountability into what it's going to move to, looking at historical data, looking at our current data and where it's moving, which helps us publish and account for that. But along those lines, if you think about the freeze storms in Texas, that happened, that was a very different cat because there wasn't this outside in perspective of it. It was widespread and everybody needed that fixed immediately. There's a bigger demand on the supply chain at that point because it was all at once. They were smaller in general, but that's interesting to look at those different types of cats and how they may impact pricing and supply and demand.
Yeah, that's a good point, Greg. We would take a similar approach, right? As you said, work from the outside in. Some of the areas that are most heavily affected, I mean, we wouldn't be able to access for days, weeks, even months. You look at Sanibel Island, right? Who knows when that will be, readily accessible, if you will. So similar approach on the content side. What's different though, in the two examples that Greg brought up, Texas, there was a lot more contents involved, at least that was covered by the insurance claim, right? So that was actually the largest cat event that we've seen in Servio's time. That was as busy as we've ever been. But when you look at a hurricane, there's a lot of storm surge, there's a lot of flooding. A lot of those situations, there may not be contents that are covered unless the insured has a separate flood policy. So we were actually busier in that freezing event than we have been in some of these hurricanes.
Sure. So we've got just over 2 minutes here. There is a question in the chat. There have been increased right to repair legislation movements. If more of those were to pass, how would that impact insurance? Not sure if you guys are prepared to speak to that, but.
Good question.
Yeah, I'm just trying to make sure I understand the question. When you say repair legislation movements, what are you meaning by that?
Yeah. Trevor, do you want to unmute and ask the question?
Yeah, sure. Basically, there's been movements to allow for repairing things such as like laptops and cell phones and things like that.
So
Right
repair
now,
over replace.
yeah, more to repair. Because there's a lot of environmental waste, and then also there's an argument for unfair competition as well too, since repair businesses can't operate on these phones because the companies that made them have a monopoly.
Yeah, that's interesting. I'm not sure how to answer that, to be honest with you.
No worries.
We'll, as far as Inservio goes, we're always going to look to see if something can be cleaned or repaired before writing it up for replacement costs. So I don't know how much the legislation would kind of impact our business, if you will. But that's definitely interesting and probably something that we might need to look at.
Yeah, I mean, it could potentially make things more practical to repair too, because as it is, a lot of times it's just easier to replace as it is because there's so many, laws prohibiting non manufacturer repairs to happen.
Yeah.
Yeah, I think insurance companies are going to look at that, and if there's more openness to repair versus replace, there may be some savings in there, and they're going to look at the best ways to bring that about. I think so that may impact it as well. I know on the property side, that is something that a lot of our customers are looking at is, repair versus replace. Even for example, a roof, can I repair that roof versus replace the whole thing and put it in a fashion that's in a good state? Insurance carriers are looking at better ways to accomplish that and make sure there's no issues down the road, or they're getting the policyholder back where they should be.
Fantastic. It looks like time's up. I'm not completely clear if we're just going to be sent back to the general session, but just didn't want you to get cut off. Thank you both very much, Greg and Justin. Very insightful. Definitely learned a lot that I can apply in my day-to-day.
Thank you, guys. Appreciate it.
Thank
Thanks
you.
for having us.